So today we are coming to look at two basic standards. So this standard has to do with what we call goods that the company purchased with the intention of reselling it. Okay, if you buy goods with the intention of reselling it, or if you're in a software company, it means that you'll be selling softwares. So anytime that you purchase a software, how much should you attach to the software in your books? How much should be attached to the software? So if you purchase the software, this is an asset. How much are you going to put in the books in regards to the software? That in the statement of financial position, you have software there. How much you attach to it? How much you attach to it? And what should you do afterwards? So we are coming to look at inventories, a standard that regulates inventories, which is the IS2. And we also look at a situation where the company will be buying the software for rental purpose. So they will give the software to people for people to use, and they will get some amount of money on it. Not that they are coming to sell the software, but they will be giving it out to people who want to use it, and the people will pay something small. That is an investment property. So we'll be looking at inventories, which we are going to finish within the next 30 minutes. Then we come to investment property, which we'll be finishing within the next 1 hour or the next 2 hours from now. Okay. So let's come to inventory. If they say inventory, we are talking about something that the company purchased with the intention of what? Resell. Inventory means something that the company purchased. An asset that is purchased with the intention of what? Resell. So inventories are called purchases. Inventories are called what? Purchases. So if you have purchases, that means an inventory or asset that the company is going to sell. Or inventory is an item that is that form part of the normal trading activity of the company. So if you are a car dealer, whenever you purchase car, the car is an inventory for you because that is what you sell. So whenever you purchase a car, the car will be classified as an inventory. But the person who is selling motorbikes, the person purchased car, the car will be classified as a non-current asset or as a PPE. But if the person is selling the motorbikes and the person purchased motorbike, the person is buying what we call inventory. So in that case, the inventory or the motorbikes will be classified as a current asset and inventory. Okay. But so whenever they say purchases, that is why we don't have stock accounts. We have purchases accounts. So the purchases accounts, or if you say purchases means something that the company purchased with the intention of reselling it. So if you purchase an asset with intention of reselling it, or if you buy what you are selling, that is what we call the inventory, and that is what we call purchases. But whenever you buy what you are not selling, whenever you acquire a fixed asset that is not part of your normal trading activities, whenever you acquire it, that is called purchase. So we have a difference between purchases and purchase. Purchases has to do with acquisition of inventory, and purchase has to do with acquisition of other assets rather than what? Inventory. So fixed assets and those ones are all purchase. Okay. But the question now is the inventory. The inventory, as we said earlier on, inventory is an asset that is bought with the intention of reselling it. So anything that you purchase with the intention of reselling it, that particular thing will be classified as an inventory. But if you come to a manufacturing company will be having so many types of inventories. A manufacturing company, like tab. Okay, all right. Yeah, let's take picture. Okay. Okay. So a manufacturing company will be having so many components of inventories. A manufacturing company will be having so many components of inventories. Okay, let's look at it. Okay, a manufacturing company will be having an inventory that is ready for sale. They will be having an inventory that is ready for sale. So a manufacturing company will be having an inventory that is ready for sale, which we call the finished product or finished goods. So an inventory that can be, or that is held for sale, or that can be sold in its final stage. That's what we call the finished goods. A manufacturing company can also be having what we call work in progress. Work in progress. And a manufacturing company can also have what we call raw materials. Raw materials. And they can also have what we call consumables. They can also have what we call consumables. So types of inventory, we have basically 4 types of inventory, which is the finished goods. Goods that can be what? That are ready for sale. Finished goods, goods that are head for what? So, finished goods, the good they are in a state that can be sold. We have work in progress, the goods that are here to be ready for sale, but they are not raw materials. They are in the production line. So we need to do some work on it for them to be what? Ready for sale. You can also have a raw material, a material in a state that you have to convert it to what? To a finished good. And we can also have what we call consumables. The consumables, they are normally consumed together with a finished product, or they are consumed in the production process. Example can be a sandpaper. A sandpaper. So if you buy a sandpaper, it means that you are going to use a sandpaper for something. So after this thing, maybe you might use all the sandpaper, or some of them might be left. Okay, so these goods, the consumables, they are not purchased for their own purpose, but they are always purchased. They are not raw materials too, because they don't form a major part of the product. They are something that is going to be used. They are form of what? Direct expense. They are something that is going to use for the product. It can also be packaging, parcel, those things that you buy and put goods in it and deliver. Okay, so those are what we call the consumables. Those are what we call the consumables. But the question now is, if we purchase the raw material or we purchase the finished goods, if you are a retailing company, if you purchase the finished goods or you purchase the raw material, what amount are you going to attach to them, which we call the initial measurements, So what amount, if you go to your statement of financial position and have inventory, what amount are you going to attach to it? Okay, what amount are you going to attach to it? This also follow the principle of what? The PPE. So the amount that you are going to attach to the inventory depends on the form that the inventory is coming in. So the question is, are you producing the inventory yourself? Are you producing the inventory yourself? So if you are producing your inventory yourself, okay, so if you have self-built or self-manufactured inventory, so if you are producing the inventory yourself, it means that you are going to incur what? Material cost. So the cost of the inventory that will appear in the statement of financial position, which is a finished product, will be the cost of the raw material. But the cost of the raw material should include the cost of the material used. If you have any unused material, you take it from the total cost of the material. Then you also incur a direct labor cost. Okay, the direct labor cost, you are going to use the cost incurred in the production process. If there's an idle time, you have to what? Take the amount paid for the idle time, because the idle time was not used in producing the inventory. Okay, another one is you can also have direct expense. Okay, direct expenses can be like you acquire some paper or you acquire other consumables which we are used in the production process. So you only add the cost of what? The consumable that has been used. You can have the consumables, you use some parts, and some of them will be left. So the question now is, what is the cost of the one that you have used? Those are the ones that you are going to what? You are going to add to get the initial cost of the inventory. Okay, you can also buy the raw material where you are going to incur a delivery cost. Or you are importing the material, you are going to pay import taxes. All those things should be added to the finished product because you are incurring those costs on the raw material. So the cost of the raw material will be the raw material, the purchase price itself, less any trade discount, plus delivery cost, plus any taxes, and all those things. Okay. Another issue that I want to talk about is that can a borrowing cost be capitalized on self-built inventory? I want to ask that question. Can a borrowing cost be capitalized in respect of inventory, a self-built inventory? Can we capitalize a borrowing cost on that? A borrowing cost on the inventory. If you are self-building the inventory, can we capitalize a borrowing cost on that?
So I think yes, because it will take a substantial period of time to have the product, work done to become a finished good. So I think we can capitalize it.
Okay, that is nice. That is all. So since the inventory is going to take a certain period for it to be ready for sale, the cost of the interest or the cost on the amount that you borrow to purchase or to finance the construction or the manufacturing of the inventory within that period, the borrowing cost or the interest cost relating to the period, that particular period of production should be capitalized, should be added towards to the value of the inventory, because the inventory is going to take a substantial time for it to be ready. Okay, so if you are self-building the assets, if you are self-constructing or self-manufacturing the assets, these are the costs that will be capitalized, or these are the costs that will be put together to have your initial cost of the inventory. Another question is, if you purchase the inventory directly, you are not going to produce the inventory, or you're not going to manufacture the inventory yourself. You are going to buy it. You are going to have an outright purchase. So you are buying it from the market. So the inventory is already in its finished stage. The inventory is already in its finished stage. What are some of the costs that will come there? The cost will be the purchase price, less any trade discounts, Then we have delivery costs, any cost that will be incurred to bring the inventory to the stage that it will be ready for sale. So delivery costs, taxes. These taxes should be a non-refundable taxes. Okay, a non-refundable taxes. We don't install inventory. If you store the inventory, how will you sell it? No. So inventory, if there's an installation cost, ignore the installation cost. We can't install inventory. The inventory will be passed to a third party. You are going to give the thing to a third party. And now you are coming to say that you are coming to install it. Or you are going to install it at the premises of the person. No. Okay. Even if it's a plant, you can't install a plant before you sell it. No. It is the person who is going to install the plant, not you. So installation costs should not be capitalized for inventory. Okay. So any other cost, borrowing costs will not come here before, because the inventory is already in a stage that it can be sold directly. But if the company has to do some kind of maintenance and some kind of things on the inventory for some like 3 months or 6 months, they have to carry out a certain work on the inventory before it will be available for. So the borrowing cost relating to the loan used to do that kind of operation on the inventory should be capitalized. But if the inventory can be sold in its stage, then we can capitalize the borrowing cost on that. So this form the initial cost of the inventory. This is the initial measurement. So if the inventory is a finished goods, the thing is, are you producing the inventory yourself? If you are producing the inventory yourself, then the question now is, what is the material that you use? What is the cost of labor that you use? What are the other direct expenses that you use? Those should be combined together to have the cost of the inventory. But if you want to value a work in progress, the question is, what is the cost that you have incurred up to that stage of the production? So if you see there is a work in progress, it means that a work has been carried out on that particular inventory. So what is the cost of the work carried up to that stage? You put all those costs together and now make it to be the cost of the what? The work in progress. So if the work in progress, you have to use a material of 2,000, and you also incur a labor cost of 5,000. Okay, the cost of that work in progress will be the cost that you have incurred up to that stage of the production. So you put all those costs together up to that stage of the production. That will be the cost of the work in progress. But if you come to raw materials, what is the purchase price of the raw material? What are other relevant costs that you have incurred in relating to the raw material? It can be a delivery cost, it can be import duties, or all other costs should be added together to have the cost of the raw material. If you come to consumables, what is the purchase price of the consumables? Did you incur any direct expense or any direct cost to bring the consumable to the state that can be ready for use? If no, the cost of the consumables will be the purchase price less any trade discounts. At the end of the year, you ask yourself, what is the portion of the consumables used and what is the remaining portion? So you get your price, then you subtract your closing stock. Then the portion now will be the consumable used for the year, which will be added to your cost of sales. And that's when in PSE, you total all the goods and services, you add consumables, their initial cost of the consumables, then you subtract the closing stock. Subtracting the closing stock from the actual cost is telling you the portion of the consumables that you have consumed during the year, which should be charged to what? Cost of sales. So that is the initial measurement of what? Inventory. After you have put the inventory and the statement of financial position, or after you have recorded it in your books, at the time of purchase, you say that you now have purchases of this amount. At the end of the year, how are you going to measure the inventory? At the end of the year, which we call the subsequent measurement. Subsequent measurement, inventory should be measured at lower of its cost or net realizable value. Why are we doing this? We want to ensure that the inventory is not carried at an amount that we can recover from it. So you recognizing the inventory at a lower of cost or net realizable value, you are doing what we call impairment. You are carrying out impairment tests on the inventory. So I want to use this opportunity to say that don't say current asset doesn't impair. Current asset, all assets impairs unless there is no condition indicating an impairment. So we carry out a yearly impairment test on the inventory to determine the net realizable value and also the cost. Any of them that is lower, we pick it. That is a subsequent measurement of the inventory. How do we determine the net realizable value? How do we determine the net realizable value? Assuming the cost of the inventory is 2,000 per unit. Okay. And they are saying that if you want to sell the inventory, it means that you have to incur additional cost, which is cost of completion, which they will always say cost of completion. You have to incur additional cost of 50 cedis per unit. Okay. And the cost to sell, which can be advertising or it can be commission paid to the person who is selling it. So the cost to sell is 100 cedis. And the selling price per unit is 2,100. Okay, let's come here. If we decide not to sell the inventory, are we going to incur the cost of 50? If we decide not to sell the inventory, are we going to incur the completion cost of 50?
No.
Okay. If we decide not to sell the inventory, are we going to incur the cost to sell of 100 cedis?
No.
Okay. So you can see that these costs are coming in because we want to sell the inventory. Okay. So if you want to sell the inventory, you are going to incur a completion cost of 50. And you're also going to incur a cost of 100. And you are going to sell the inventory for 2,100. All things being equal, you are only going to realize 1950 from the sale. because the 2,100, 50 of it will be used to settle completion costs. 100 of it will be used to settle what? The cost to sell, the commission. So in actual sense, the net realizable value or the amount that you'll be getting from the sale will be 2,100 minus 150. So this is how we find the net realizable value. So the net realizable value is calculated as the selling price minus the cost of completion minus cost to sell. Cost to sell. Okay, cost to sell. If you read the notes, you can see that I said that the initial measurement of inventory is the cost, is the purchase price plus any conversion cost. The conversion cost can be the labor, the material, and all those things. Any cost that you are going to incur to convert it. So the conversion cost is the production cost. That's what they are talking about there. So the cost that you are going to incur to change the inventory from raw material to finished goods is something that you are saying the conversion cost. Okay, so don't be confused with that. All right. So the net realizable value is determined as the selling price minus the completion cost minus the cost to sell. That's how we determine the net realizable value. Do I have something to say again? Okay. If you come to inventory, you can see that we have, if we are having maybe the inventory in kilograms, we can also determine, okay, you can see in course or in introduction to management accounting, we look at something that we call stock valuation methods, isn't it? I'm not sure. Is it stock valuation methods where we have the FIFO, LIFO, and those things?
Yeah, cost accounting.
Okay.
Yes.
Is it stock valuation methods or what?
Yeah, it's stock valuation method.
Okay. So under inventory too, we have basically three methods that a company can choose to value their closing stock. This one we are going to value only our closing stock. We are not valuing the initial what? The initial inventory. The initial measurement should be the cost plus any direct attributable cost to bring the inventory to the state that it can be ready for sale. But the subsequent measurement, the company can decide to use either any of the stock valuation methods. But we have only what? Three. We have only three. The first one is we can use the actual unit cost. So the actual unit cost is the amount that we purchase the inventory. How much is it? How much did we purchase it? That is an inventory. And this is always for asset that cannot be what? Interchanged. Asset that cannot be interchanged. If you are talking about asset that cannot be interchanged, we are talking about asset that cannot be used for numerous purposes in terms of production. Asset that cannot be exchanged for another asset in a production process, or asset that cannot be exchanged for another process during the selling process. So example that I put over there is the used car. A used car cannot be used to produce additional car or another car. But if you have beans, if you have the beans from that stage, you can use the beans to prepare gobe itself. You can also use the beans to prepare wache. You can use the beans to prepare a lot of things. So the beans can be used or can be exchanged for other things during the production process. The beans can be used as a substitute for additional one. So if you are having an inventory that cannot be interchangeable, inventories that cannot be interchanged, that are not interchangeable, we use the actual unit cost. How much did you buy it? So multiply the amount by the remaining what inventory there. Okay, but if you are looking at inventory that can be exchanged for another inventory in the production process or in the selling process, which the example over there is the tins of beans. Tomatoes can be used for so many things. You can give it tomato and take another thing. So in that case, you have the choice to select between the FIFO method, which is the first in, first out, or you have the right to select the weighted average cost of what? Capital. Or weighted average cost of what? Valuation. We don't use LIFO. The standards what? Forbid the usage of what? LIFO. So we don't use LIFO in our stock valuation. The standard recommend or permit only two, which is the first in, first out, and also the weighted average cost of capital. All right. Basically, this is about inventory. How do we measure inventory? Inventory, the measurement follows the principles of PP, any other asset, the purchase price plus any direct attributable cost to bring the item to a stage where it can be ready for sale. Subsequent measurement, it should be lower of cost or its net realizable value. If the company wants to use stock valuation methods, the company has to use what? The FIFO or the WACC to value their closing stock, I don't know whether I'm missing something there. Okay. I'm not missing any other thing there. So this is all about inventory. We are going to pick the tutorial questions. Let's pick tutorial question 3. Let's pick tutorial question 4 first. Then we come to tutorial question 2. Then we move on to investment property. So tutorial question 4 first. Let's take the 4 first. Auntie Eunice, are you there? Auntie Eunice, are you there?
This consumer electronics buys goods from an overseas supplier. It has recently taken delivery of 1,000 units of components X. The quoted price of component X was 1,002 per unit, but DCE has negotiated a trade discount of 5% due to the size of the order. The supplier offers an early settlement discount of 2% for payment within 30 days, and DCE intends to achieve this. Import duties of 60 cedis per unit must be paid before the goods are released through custom. Once the goods are released through customs, DCE must pay a delivery cost of 5,000 to have the components taken to its warehouse. Required, calculate the cost of inventory for DCE.
Okay. So what will be the cost? What will be the component of the cost?
The component of the cost will be the quoted price, which is 1,002, and less the 5% trade discount. And I don't know whether the settlement discount will come in here as well, but then we'll add the import duties and then the delivery cost.
Okay. So the first one should be the purchase price, isn't it? Okay.
Yes.
The purchase price will be 1,200 times what? The 1,200 is per unit times the unit that they are buying.
1,000 units.
1,000. Okay. That will give us 1.2 million. Is that correct?
Yes.
Okay. Then we have our trade discounts. Our trade discount will be 5% of that, isn't it? 0.05 times 1.2 million. What are we getting?
That's 60,000.
60,000. Okay. Okay. The question now is there's early settlement. That is a cash discount, isn't it?
Okay.
What did we say about cash discounts? Whenever you have a cash discount, it should be treated as what? As a profit or loss what? Item. So if you are coming to capitalization, we use only what? Trade discount. Even if the question says that a person is ready to meet the settlement, no. The trade discount is not time bounded. Are you getting it? So the trade discount, whether you pay early or not, you still enjoy what? The trade discounts. But I say that the person who is planning to what? To achieve this. How do we know? If you say that you are going to build a house in 2 years' time, it might happen that it will take you 5 years' time. So we can't base on the 2 years and say no. So cash discount is always treated as a profit or loss what? Item. We only subtract trade discounts from the purchase price. Okay, let's come to other relevant costs there. Without paying the import duties, can you have the inventory?
No.
Okay, so the import duty is a cost, it's a relevant cost that will be incurred to bring the what? The inventory to the premises of the company, and that's 60 times 1,000. I'm getting 60,000. Is that correct?
Yes.
Okay. So DC must pay a delivery cost of what? 5,000 to have the component taken to its what? Warehouse. If you don't pay the delivery cost, the inventory will not be on your premises. So the delivery cost is also a relevant cost here. Delivery cost is also a relevant cost. So that would be what? 5,000. So what will be the total?
1,205,000.
120.
5,000.
5,000. Okay. That is basically the cost of the inventory. Okay. I've forgotten to say this. You can see that inventory cost should not include abnormal waste, storage costs, administrative overheads, those costs that are not relating to the production. Abnormal waste should not be included. Storage costs, we have already prepared the inventory for sale. It's just that we are going to put it somewhere. That particular cost is not a cost that is relevant to the inventory. So that storage cost should be treated as what? As an expense. Interest costs when inventories are purchased with a deferred settlement terms. So you purchase the inventory, and instead of you paying today, you want to pay later. So the person is going to consider a time value of money. No. That particular cost or interest that you'll be paying as a result of the time value of money should not be added to the cost of the inventory. Should not be added to the cost of the inventory. Okay, that's what they are saying there. Foreign exchange. If you have time, you can read that. Let's come to question number 2.
Number what?
Number 2. Tutorial question number 2.
SCNAM Limited has the following products in inventory at the end of 2016. Ahomka is completed. Adonko is part completed. You have 5,400 to 2,800 units, respectively, at the price of 22 and 26. It says each product normally sells at 34 cedi per unit. Due to the difficult trading conditions, SCNAM Limited intends to offer a discount of 15% per unit and expects to incur per unit in selling cost. 10 cedi per unit is expected to be incurred to complete each unit of Adonko required in accordance with IAS 2 inventories. At what amount should inventory be stated in the financial statement of SCNAM Limited as at 31st December 2016?
Okay. Okay. So the question is, Ahonka is completed. Ahonka is completed. It is in a state that can be sold directly. But Adonko is part completed. So if you want to sell it, you have to incur a completion cost. Each product normally sells at 34 cedis per unit. Due to the difficulty trading conditions, SCNAM Limited intends to offer a discount of 15% per unit and expect to incur 4 cedi per unit in selling what cost. 10 cedi per unit is expected to be incurred to complete each of what? Adonko. Ahonka is already completed, so we can't incur any completion cost again. So completion cost is always incurred on a work in progress or a raw material. Okay, let's come here. The principle over here, they are asking you to tell us the amount that a company should recognize the inventory at the reporting date. So what they want to test over here is the lower of cost or the net realizable value of the inventory. So let's come to the first one. Ahomka. What is the cost of Ahomka? What is the cost?
22 per unit.
Okay, but the unit is what? How many units are there?
5,400.
So 5,400 times 22. What is the total cost?
That's 118,800.
118,800.
800.
Okay. Okay, you can also find the cost, all the costs at once. You can also find the unit basis before you multiply. Okay, let's come to the cost of what? Adonko. What is the cost of Adonko? Currently, what is the cost? That will be 2,800 times what? 26.
20.
Okay. How much are we getting?
17,200.
72,000.
800.
Okay. 72,800. Okay, let's now come and calculate their net realizable value. So the net realizable value will be calculated as the selling price. So what is the selling price now? What is the selling price per unit?
34.
34. But this 34, what is happening? Would that be
There's
the
a
actual selling price?
no.
Okay, so we find the actual selling price now because we are given a discount of 15%. So the actual selling price will be 85%. Am I correct with that?
85.
Okay.
Yes.
So we have 0.85 times 34. What are we going to get?
28.9.
28.9. But we are going to incur selling what? Cost to sell. So let's count the cost to sell. Let's do it for all of them. So let me do it for the first one, which is a home car. The net realizable value for a home car. So we have the cost to sell. Cost to sell. How much is the cost to sell?
Cost to sell is 4.
Cost to sell is 4. So,
Yeah.
so the net realizable value for a home car will be what? 24.9 per unit.
It's 9.
So we multiply by the total unit that they have. And that will give us 5,400 units. What will be the total amount?
That's 13,446.
134,000.
34,460.
460. Okay. This is the net realizable value. And what was the cost? 11,800. So what amount are we going to measure the inventory? Is it the net realizable value or the cost?
The cost.
The cost, because the cost is lower than the net realizable value. There is no impairment on the inventory. There is no impairment on the inventory. And the net realizable value is the same as the recoverable what? Amount. Let's count the net realizable value for Adonko. Okay. Adonko, we are going to have our selling price. Our selling price of 28.9. $28.9. And our cost to sell is how much? Cost to sell.
Our cost to sell is 4.
4 cedis. And are we going to incur any other cost to complete it before we sell?
Yes.
Yeah.
Okay. So completion cost,
Yes.
that will be 10 cedis, isn't it?
Yes.
Okay. So the total amount that we'll be having now is what? The net realizable value will be how much?
That's
14.9.
14.9.
Okay. So we multiply by the units to get a total. So how many units do you have there? Okay. So if you multiply, what are you getting?
41,720.
Okay. 41,720. So what is happening?
Net realizable value is low.
Okay. But in the books of the company, they are having the inventory at this amount. So we have to find the impairment now. how do we find impairments? Impairment will be calculated as the carrying value minus the what? The net realizable value, or the net realizable value minus the what? The cost. The cost is the same as the carrying value. That is the value of the inventory in the books of the company. So we have 41720 minus 72800. What would be the difference? What is the difference?
31 and 80.
Okay. 31
080.
080. So this will be shown as what? How are we going to show this? Okay, so this, we are going to write the inventory down to this amount. So we are going to subtract this from the inventory in the statement of financial position, and also treat these ones as an expense in the profit or loss. So what we do is that we debit cost of sales with the 31080. Then we credit the inventory. Crediting the inventory means you are going to reduce the value of the inventory. So credit the inventory with 31080. So if the inventory is reducing, if there's an impairment loss in the inventory, what will happen is that you have to go and subtract that particular impairment loss from the inventory in the statement of financial position, because you have to come and write the inventory down to what? To the net realizable value. But in the books of the company, it is 72,800. What do we do so that the 72,800 will now become this one? We subtract this particular difference from this in the statement of financial position. Then what do we do? This particular is an impairment loss. But inventory is treated as part of what? Cost of sales. So this impairment loss will be treated as an addition to cost of sales. Okay, HP, I saw your hand up.
Yes, sir. Why are we calculating impairment? The question is silence on that.
What makes you think the question is silence?
It's pointing out that you should calculate the impairment if necessary.
So that if the question says that you should calculate the impairment if necessary, that is why you know that you should calculate impairment.
To my understanding, yes.
Okay, thank God that you say it to your understanding. Okay, I accept that. The question says that in accordance with IAS 2 inventories, at what amount should inventory be stated in the financial statement of SNR Limited as at 31 December 2016? We know that the company has already recognized what? The inventory. So they have initially measured the inventory, or they have initially recognized the inventory. So they are asking us to do subsequent measurement. Subsequent measurement should be lower of cost or its net realizable value. If the cost is higher than the net realizable value, that is an impairment. So that's what we are looking for. The loss is what I'm calling impairment. The inventory has impaired by 31080 because the carrying value is higher than the net realizable value, which is the recoverable amount by that particular figure. So if the carrying value is higher than the recoverable amount, we have what we call impairment. So it's not a question I have to ask you if impairment, and no. Are you okay?
Thank you.
All right. Let's come to investment property, ladies and gentlemen. Let's go to investment property. Okay. Okay. So last time we said that a company can purchase a land for so many purposes. So last time we looked at where the company will purchase the land with the intention of what? Using it for their own good. They will use it for, maybe they want to bid on it, or they want to use it to carry out business activities. In that case, the land will be classified as owner occupied, which will be accounted for using PPIA system. We have also looked at another standard now, where we say that the company can be holding the land for what? Trading purposes. Real estate company. They will be selling the land to people. They will be selling the land to people. In that case, the land becomes an inventory and should be accounted for using the IAS 2. which is what we have looked at right now. What if the real estate company is having the land for rental purpose, give it to people to farm on it and pay them some small amount of money, or give it to people to bid on it for some time, then after the contract period, they will take the land back. Okay, but this particular land they are giving to the people, the risks and the control associated with the land should not be transferred to what? To the people who are going to occupy the land. If that happens, then that particular transaction will be a lease. So we can also have a lease, which is the renting. But if you rent the land to the people and the people have to take care of what? The maintenance. When there is a soil erosion, people have to come and take care of the what? The land. They have to bring the land to its original form. If there's any security issue, the people have to take care of it themselves. If that is the case, you are renting, but that particular type of rent should be called a lease, a finance lease. Should be called finance lease, and the company have to account for it using a finance lease. But we are talking about situation where maintenance of the land, the risks and everything, it will be the company that is going to take care of them. If there's any security issue, the company is the one that is going to suffer it, that is going to provide it to the people. In that case, that particular land can be classified as an investment property because it's an operating lease. So all operating lease are seen to be an investment property. Okay, a company can also be keeping the land with the anticipation that maybe if the value of the land appreciates in the future, they are going to sell it and get some amount of money on it. In that case, we can also use the land as an investment property, where they are keeping the land and they are carrying it through the fair value model. If a company is also constructing a property, which they are here to determine the use, the standard says that it is likely that they will choose what? The investment property method. Because if you are building, you don't know the purpose for it. It can happen that when the value of the building appreciates in the future, you might be likely to sell it. So in that case, you should use the investment, or you should classify that particular project as an investment property. So a land with undetermined use should be classified as an investment property. A building which is under construction, but the purpose is to lease it out. If it is completed, it should be classified as an investment property. You are constructing a building. The intention is that you are going to give it to people for rentals after you complete it. The finished or the work in progress or the uncompleted building should be classified as an investment property. So investment property is an investment, or is an asset that you are holding for rental purposes or for capital appreciation. Rental purposes means you are going to give it to people, and the people are going to take care of what? If you are renting a story building to people to come and put for the people to come and sell in it, the people are coming to do their own shelf and other things. Okay, but if you come to a hotel, let's look at a hotel. Hotel. How are we going to classify the hotel? Is it going to be an investment property, or PP, or what? A hotel. If you have a hotel, how would a hotel be classified?
Investment property.
Are you sure?
Yeah.
Why are you saying it should be an investment property, a hotel?
Because one, you are not selling the rooms, so it is not inventory.
Okay.
Two, you are renting it out on daily basis. So once you are holding it to earn rent income, it's an investment property.
Okay. But this one, everything in the room is provided by who? Everything in the room is provided by who? The owner, isn't it?
Yeah.
You can see that in the same hotel, we are selling food, we are selling drinks. I hope you are getting the part of my argument. In the hotel, we are selling food, and we are also selling drinks. Can we also say that we are using the hotel to generate money through the food and all those things?
Yes.
Okay, so hotels should be classified as a PP. Hotels should be classified as what? PP. Investment property only comes into play when the service that the lessor is going to render to the lessee or the occupants is not that significant. If you come to hotel, the service that the owner is going to render to the occupants is very significant. Is very significant. He's going to provide a bed, everything in the room. But if you come to investment property, okay, the only best thing I can do for you is to give you the room. Then you are coming to what? To finish it. So if I'm renting
differentiate between hotel and Airbnb.
Which one is the Airbnb?
Let's say I have my own building, a number of flats, fully furnished. I rent them out to individuals on short basis. What's the difference between that one and a hotel?
Oh, I mean, that one is like hostel. It's not hostel.
No, I don't think it's like hostel.
No, the hostel, everything will be inside. Everything is inside the room.
Yeah.
Or it's just like a guest house.
Yes, just like a guest house sort of.
The guest house should also be classified as a PP because you are providing everything. The service that you'll be providing to the person is very significant.
In the case where it is not a fully furnished space, then it goes to investment property.
If the occupant is going to bring the thing, like the normal rentals that we do, you see the people will build and they'll give the room to, and you bring everything to the room, isn't it?
Yeah.
The best thing that the person can do is to provide security or some minor maintenance. In that case, the building or the asset should be classified as an investment property because the owner is providing a service that is insignificant. The only thing that the person can do for you is maybe provide a security. If there's any issue, you call the person, landlord, this is the issue. But they will not come and put the bed, the chair, and everything in your room. You are going to take care of everything. Are you getting the argument? So you classify an investment property, you can also look at the service that the owner will be providing to the occupants. If you come to the stores, the renting of the stores, who will put the goods in the store? Is it the owner? If you come to stores, renting of stores, who is going to stock the room with the goods? It's going to be the occupant, isn't it? The tenants.
Yeah.
Okay. So you can see that the only thing that the owner can do is to give the room out, empty room, and the tenant will come and do everything to suit his or her what? Test. Okay.
But they are all using it to generate income.
No, they are using it to generate income. But what is the service after giving the room out? What is your service that you are giving to the person? It's not about all generating income. It's not about all generating income. If you are using the building, if the building is for the owner, and the owner is still having his or her own inventory in that particular site, you can see that we are still using the building to generate income, isn't it? If you have your own office and you are selling, you have your own warehouse and you are selling there, you can say that you are using the warehouse to generate what income. Can we say that that particular warehouse should be classified as investment property? All assets will be used to generate income. All assets will be used to generate income. But if you come to investment property, we consider the service, the level of the service that the owner will be rendering to the tenant. If the service is minor after giving the room out, what will be the additional service that you'll be providing? If the service is minor, like maintenance and security, we can go ahead and classify the property as an investment property. But if the owner is going to provide a service that is significant, it's a hotel. The hotel, you won't come there with your own food. It's not possible. Sometimes it's not possible. You can't go to a restaurant with your own food. So everything will be done to you by the owner. But these are some of the issues that they cannot examine you on in the exam. Are you getting it? They will be straightforward to you, that the property is an investment property. Okay, let's move on. Senior Tete, I hope you are okay, but you are finding difficult to be okay. Don't worry. If you come to my level or you after you chapter, then maybe you understand. Okay. So the advice is that though the focus is to pass the exam, but try to read more about what you are learning. Sometimes ask yourself, why should this thing be like this? Why should they say this thing should be like that? Okay, think about it, and at least the understanding will come. Okay, people who do baba, yes, you just cheer and pour. It's not good. Okay. Before we move on, I want to say something. How do we think we should account for what players? If a team is it purchase? Can I use purchase? Or if Man City, can we say purchase? Man City purchase or Man City bought this one. Which of Ghanaian players can go there? None of them. So if Man City bought Neymar Jr., how are they going to account for that? Okay, think about it. We look at that under intangibles, IAS 38. Okay, let's move on to the investment property. So the investment property, we are saying that any asset that you have with the intention of what? Giving it out to earn rentals or to hold it when the value appreciates, then you take advantage of that particular appreciation. We say that particular asset should be classified as what? Investment property. Okay, when should we recognize an investment property? The recognition criteria is the same as an asset. It's the same as an asset. When it is probable that the asset is going to give a future economic benefit to the entity, the amount can be measured reliably. There's a sufficient evidence of what? The asset existing. Okay, the question is, what is the initial measurement of the investment property? Initial measurement. How do we initially measure the investment property? If you have investment property, what value should you attach to it? That's what we mean by the initial measurement. The initial measurement follow the principles of what? The PPE, any asset. The first one is the cost price or the purchase price minus any trade discounts, plus any other relevant cost, any other direct cost that is attributable. So if you are buying this tricycle for use, you are going to incur delivery cost. Okay, you're also going to, there will not be any installation cost to the tricycle because they will do everything before giving it to you. Okay, but sometimes these cars or vehicles, they are going to dismantle it before bringing it. So you have to get someone that is going to fix it. But mostly the seller will fix it themselves. So any other cost, delivery cost, import duties, if you are going to construct a building that you are going to lease out, you are going to be incurring a professional cost. Any other cost that is relevant to that particular one will also be added to the initial cost. So the question is, if you are buying the investment property outright, what is the potential cost? What are direct costs that you are going to incur to bring the asset to the state that you can start renting it out? Put all those costs together. If you are self-constructing it, what are the costs? The material you use, the labor, any other direct costs, borrowing costs, and all those things should be capitalized. So that is the initial measurement of the investment property. That is the initial measurement of the investment property. The next one is, how do we subsequently measure investment property? How do we subsequently measure an investment property? Okay, if you say investment property, we are saying that the asset that is held for rentals or for capital appreciation. Okay, a land with undetermined what? Use or future use. A land that we have, but we don't know what we are going to use it for. The standard says that that particular property should be classified as an investment property. A property on asset that is under construction, but the purpose is after it is completed, we are going to use it for rentals. That particular work in progress should be classified as an investment property. Any other property that is leased under operating lease should be classified as what? Investment property. Property that is owner occupied, property that you are using for administrative purpose are not investment property. They are PPEs. Property that are held for sale are not what? Investment property. They will be classified as an inventory or non-current asset held for sale and discontinued operation. So sometimes they will give you a question. You have to see whether it is an investment property or not. Let's look at the example there. Which school owns a piece of land? The directors have not yet decided whether to build a factory on it for use in its business or to keep it and sell it when its value has risen. Would this be classified as an investment property under IAS 40? The answer is there. Yes, if an entity has not determined that it will, if an entity has not determined that it will use the land either as owner-occupied property or for short-term sale in the ordinary course of business, the land is considered to be held for capital appreciation. That's what we have said already. What are the things excluded from the what? From the IAS 40? Owner-occupied properties are what? Excluded. They are under PPE. Assets that are held for what? So in the ordinary business activities, that is an inventory. Assets that are leased under finance lease, they are not part of this particular investment property. Okay, let's come here. If a parent rents out each part of its property to a subsidiary in the separate financial statement of the two companies, how are they going to account for this? A parent rent out part of what? Each property to a subsidiary in the separate financial statement of the parent and the subsidiary. How are they all in the financial statement of the parent? How would the parent be classifying this particular property that they are rent out to, or they are rented to the subsidiary? How are they going to classify it?
PPE.
No place. In the books of the parent. We are talking about their separate financial statements.
In the books of the parent, it's investment property.
Okay, it will be an investment property in the books of the parents. But if you come to the perspective of the group, should that be classified as an investment property?
If it's a group, then it becomes owner occupied.
It becomes an owner occupied because the subsidiary is part of what? The group.
The
So
group, yeah.
if a parent rent out a part of its facility or property to a subsidiary in their separate financial statement, the parent will be recognizing this as what? As an investment property. But if you're preparing a consolidated financial statement, no, the subsidiary is part of the group. So that particular asset will be classified as owner occupied. So you have to use PP, depreciate it. So any gain that the parent is getting from the investment property, all those gains must be what? Reversed in the group account. Okay. If a company gave out or rents its facility to employees, how should that be accounted for? Should the company be classifying that particular property as an investment property or a PP?
If the company is taking money or deducting from,
they will take money. It's not for free. They will take money. It will not be for free.
So if they take money, then it's an investment property.
Really?
Yes, because that is not their main. If that were their main course of business or operations, then we could say PPE. But if it's more or less something to cushion employees and they take money from them as well, it's PPE, unless you have a different argument. But that's what I think.
No, it's not unless I have a different argument. I have a different question to ask. At that stage, the employees belongs to where?
Their employees.
The employees belongs to who?
The company.
What forms a company or who forms a company? Can we say we have a company
They are
when
all
there is no
stakeholders.
workers? Can we say we
No,
have a
please.
company when there is no workers or there is no people in it? Can a company operate?
No, sir.
Okay. So, Tetel, I have a different point, not argument. So, based on the question, can a property still be classified as an investment property? Tetel. Senior Tetel, can a property still be classified as an investment property?
Yeah.
Really?
Yes.
Okay. If a company lease part of its property to employees, the property is deemed as owner occupied because the employees are part of what? The company. And even the renters that will be getting from a third party is not the same renters. They are going to give it to them as a subsidized what? Amount. And you can see that sometimes companies do pay what? Accommodation fee for employees. That are you getting the argument?
Yeah.
So the property will be classified as owner occupied and accounted for using what? PP. We only have an investment property when a property is being leased out to a known third party, an independent third party. An independent
But you
third
see,
party.
with the example we had, or with the question before this one, where the group, or sorry, the parent has given it to the group, the subsidiary and the parent, they are not third party.
But that will not be classified as investment property, but in their separate books. In their separate books. If I've given something to you, if we are two branches, whenever I've given something to you, I have to record it. I have to take note of it, isn't it?
Yeah.
Yes. So that is where they are going to, the parent will be thinking that it's an investment property. But if you are coming to prepare the account for the two branches as one, that can never be an investment property. So in the separate financial statement, the parent will be seeing that they have rented it because as soon as they have given the property out, they have to account for it. So they will be classifying it as an investment property. But if you count the preparation of the group account, that is why the two shall become one will come into play.
But with regards to the employees too,
the employees are not going to keep
for the
the
rent.
employees are not going to the employees are not entities.
But they are paying for the rent.
They are paying for the rent. Okay, they are paying for the rent. If you count to the subsidiary, will be paying for the rent. The employees are part of the company. The employees form part of the company. So it's just like the company is the one occupying what? The building by themselves. All right. Let's come to what again? Let's come to subsequent measurements. Subsequent measurements. If you come to subsequent measurement, okay, I wanted to say something. If a company can have a building and they will give some parts, they will lease some parts, and they will occupy some parts. So the company is having maybe 10 floors, and they occupy 3, and they have given 7 out. The 7 should be classified as an investment property. So the 7 that they have given are to what? An independent third party, someone that they don't have anything with. So an independent third party, okay? So we have to classify the 7 floors as investment property, and the 3 that is occupied by a subsidiary, an employee, or the company itself should be accounted for using PP. So sometimes I can give you a question where you have to determine the components yourself. The company will occupy some and they will give some out. So the part that they have given out to a third party is what you are going to be using as an investment property. The part occupied by the the company itself, a subsidiary, or an employee, or someone that is related to the what? To the company, you will be seeing that as what? As an PP, as a PP. So the subsequent measurement, the company can decide to use what we call the cost model. The cost model is the same as what? The cost model under PP, where the investment property will be carried at historical cost minus any accumulated depreciation or any impairment loss. Another one is what we call the fair value model. The fair value model, what we do is that at the end of every year, we look for the fair value of the investment property. Investment property under the fair value model does not depreciate. We don't depreciate investment property under fair value model. So it does not depreciate the assets. The only thing is we take the value, the fair value at the beginning, and the fair value at the end. The difference over there, the difference, the fair value loss or gain should be sent to profit or loss. So the fair value gain or loss should be sent to profit or loss, not other comprehensive income. Okay. The fair value should be sent to profit or loss, or yeah, should be sent to profit or loss, not other comprehensive income. Okay. So then we have the cost model and we have the fair value model. Okay. Yes, Benjamin.
Can you repeat the fair value?
The fair value,
Model.
what we said is that at the end of every year, you have to fair value the assets. You have to look for the market value of the assets. But investment property carried under fair value is not depreciated. We don't depreciate it. So if there's any fair value gain or loss, that particular amount should be taken to profit or loss. Okay. Jenna, your hand was up.
Yes, sir. You said the cost model was the historical cost less. I didn't get that part.
It's just the same as the cost model under PPE. Cost minus accumulated depreciation or minus accumulated impairment losses. Are you okay?
Thank you, sir.
All right.
Yes, sir.
Okay. Let's come to change of use. Let me talk about everything. Then we pick two questions. Change of use. Okay. Can we look at the example under the subsequent measurements? We have Celine, a manufacturing company. Can we look at that? Someone should read that. Let's look at that example. Then we move on to the change in use.
Celine, a manufacturing company, purchases a property for $1 million on 1st January 2011 for its investment potential. The land element of the cost is believed to be $400,000, and the building element is expected to have a useful life of 50 years. At 31st December 2011, local property indices suggest that the fair value of the property has risen to 1.1 million. Required, show how the property would be presented in the financial statement for December 2011 if Celine adopts the cost model. And then 2, the fair value model.
Okay, so the cost model, let's look at the cost model first. Another cost model, what we do is that we bought the property on 1st January. Okay, and they are asking us to show how we can report this on 31st December to S1. That is a year's time after the acquisition. So the cost model, what we do is that we are going to use the property for 1 year. But this property is having 2 different assets, land and building, isn't it? Okay. Land and build, if you say property, it can be either land or building, or it can be both. So in this case, it's land and building. The land component is how much? What is the land component? 400,000. So the building component will be what?
600.
So which
$600,000.
which component are we going to depreciate?
The building.
So we are going to depreciate the building. So let's calculate depreciation on the building. The building will be 600,000 divided by 50 years. There is no useful life, and the depreciation is a full year. So how much are we going to be having as depreciation?
12,000.
12,000. So statement of profit or loss, we are going to be having a depreciation for the year of 12,000. In the statement of financial position, we are going to be having a property as a non-current asset, which is 1 million minus 12,000. Okay, 988,000. Am I correct with that?
Yeah.
Okay. Let's come to the fair value model. Under cost model, we don't fair value the assets. The assets will be carried at historical cost, that is all. Under the fair value model, we don't depreciate the assets. So the cost of the property will be 1 million at the beginning. At year end, which is 31 December, the cost of the what? The fair value is now what? 1.1 million. Okay, so we now look for the gain, the fair value gain. The fair value gain will be 1.1 minus 1. So I'm going to have 0.1 million. So if you go to statement of profit or loss, you are going to have a fair value gain on investment property of 0.1 million. If you go to statement of financial position, you are going to have investment property. You are going to have investment property. You are going to have investment property to be 1.1. So at the end of every year, we fair value the asset to recognize any gain or loss to profit or loss. So we have 1 million at the beginning. At the year end, they are saying that it's 1.1 million. It means that we have to increase the value of the property now towards 1.1 million. Okay, 1.1 million. Someone can also decide to share the gain and know the part that will be for the land, the part that will be for the what? The building. It doesn't matter. At the end of the day, you'll be taking 0.1 towards profits or loss. So that is about the accounting and the cost model and fair value model. Let's come to a change in use. A change in use has to do with a situation where the company will decide to what? Take the assets from PPE to what? Investment property, or change the asset from investment property, or the company is giving the land out or the building out, but they then realize that no, they don't want to rent the building again. They want to occupy the building themselves. So that is what most of the landlords they do. If they will give you the room up to some time, they say no, we are packing in. It means that they are changing the building now from investment property to owner occupied. Or they can say, okay, we want to sell the house. They are now changing the asset from investment property to inventory. So a company can decide to change an asset from owner occupied to investment property, or from inventories to investment property, or from investment property to PPE, or from investment property to what? Inventories. How do we deal with that? How do we deal with that particular issue? So we take them one by one. Change in use. So the change in use, we can look at from PPE to investment property. Okay, if you are changing the asset from PPE to investment property, the first question that you have to ask yourself is, how are you carrying that particular PPE? Are you using revaluation model or you are using cost model? If you are using revaluation model, it means that at the date of transfer, you have to revalue the asset and you send that particular value to what? To the investment property. So at the time of the transfer or at the time of the change, you have to fair value the asset because you are carrying the asset at what? Fair value. If you are using revaluation model here, at the time of transfer, the asset should be transferred at fair value. If you want to change, you have to transfer the asset from PP at fair value to investment property. Either the company will be using cost model or revaluation model for the investment property. So if they are going to be using cost model or fair value model, you have to transfer the asset at the fair value because you are using a revaluation model. So at the date of the change or at the date of transfer, measure or look for the fair value of the asset or look for the revalued amount of the asset or revalue the asset before you transfer it. If the company is going to be using the investment property, if they are going to be using cost model or fair value model, it doesn't matter. Since you are using revaluation model, transfer the asset at what? Fair value. Okay, so if the company is using fair value or cost model, if you're using revaluation model for the PP, you have to transfer at fair value. Okay, but if you are using cost model for the PP, okay, if you're using cost model for the PP, it means that the asset is carried at what? Carrying value. Okay. The question now is, if you transfer the asset from PP to investment property, what model are you going to use? If you are going to use cost model, under the investment property, the asset should be carried at what? Or the asset should be transferred as carrying value. If you are going to use cost model, you are using cost model for PP and you are going to use cost model for investment property, it means that both are the same. So transfer the asset at carrying value to carrying value. But if you are using cost model and you are going to use fair value model here, the asset should be transferred at fair value. So at the date of transfer, find the fair value of the asset. If you find the fair value of the asset, the fair value might increase because you are carrying the asset at what? Cost model. So you have the carrying value. By the time that you transfer the asset to investment property, the asset should be transferred at what? Fair value. In that case, you'll be having a gain or something. So if you are transferring the asset from cost model to fair value model at an investment property, just assume that you were carrying the asset as what? Cost model. So at the date of transfer, you have to carry the asset at fair value to the investment property. So you have to find a gain over here and recognize that gain to other comprehensive income. You assume that you are now using a revaluation model for the PP. So if you're using revaluation model, the asset should be transferred at fair value to investment property, either cost model or fair value model. If you're using cost model, it should be carrying value to cost model. Cost model for PP, cost model for investment property. If you want to transfer it, it should be a carrying value. If you're using a cost model, okay, Teta, your hand is up.
And I was asking where you are changing from inventory property to investment property. Whether the same scenario.
I'll come to that side. So we are looking at PP to investment property now. It can also be from investment property to PP. Okay. So the transfer, the amount that you are going to use to transfer, the value that you are going to transfer the asset at to the new standard now depends on the what? On the method, on the model that you are using, and also the model that you'll be using under the new what? The new classification now. So I'm talking about PP and investment property. So if you are transferring from you are transferring from PP to investment property. If the asset is carried under revaluation model, the asset should be transferred at fair value at the date of the change. Okay. Either you are going to be using investment property, you are going to be using cost model for the investment property or fair value model. Since the asset is carried at revaluation model, it should be transferred at fair value model. If you're using cost model under PP and you want to transfer the PP or you want to change the PP to investment property and you'll be using cost model for the investment property, you have to transfer the asset at carrying value. If you're using cost model for the PP and you want to turn the PP to investment property and you are going to be using fair value model for the investment property, the asset should be transferred at fair value. The asset should be transferred at fair value. The same way, if you want to change the investment property to PP, if you're using cost model for the investment property, and you are going to use revaluation model for the PP, and you want to change the asset from investment property to PP, the asset should be transferred at fair value, because you'll be using a revaluation model for the what? For the PP. If you're using a fair value model and you are going to be using cost model for the PP, the asset should still be transferred at what? Fair value. That is, so these two, they play like that, okay? If you want to change from investment property to inventory, that's what you're saying. Okay. Let me talk about investment property to inventory. It depends on the model that you'll be using. Inventory, we don't have any model at the date of the transfer. So if you're using cost model, the property should be transferred at carrying value to this one. So this will also be carrying value. If you're using fair value model, the asset should be transferred at fair value. Are you okay? So that is the investment property and the inventory. Senator, are you okay with that side?
No, I mean the other way, from inventory property to investment property.
So from the inventory to investment property, it depends on the model that you'll be using for the investment property. If you are using cost model, then you have to transfer the asset at what? You have to transfer the inventory at carrying value. But if there's any issue about what? Net realizable value as at that date, then you have to transfer the asset at net realizable value. But all things being equal, it should be transferred at carrying value to investment property if you are using cost model. But if you are going to be using a fair value model, then you have to transfer the inventory at fair value. The fair value can be the net realizable value. It can be any other value. Okay, or someone can transfer it at the selling price of the inventory. That can also be the fair value. So if there's a change in use and you want to know how you are going to account for it, it depends on the model that you are using for the existing classification and the model that you'll be using for the new classification. That will tell you how the assets or what value should the asset be transferred. Let's look at one of the small boys, their question. Then we come to big men, their questions. Okay. Let's count one of the small boys, their question. Then we go to the big people, their question. Okay, let's take the small boys, their question. Question 2.
Tutorial question 2 or
yeah, tutorial question 2. That is a small boy, their question. Let's look at that.
ABC owns a building that is used as its head. On January 1, 2011, the building, which was measured under the cost model, had a carrying amount of 500,000. On this date, when the fair value of the building was 600,000, ABC vacated the premises. However, the directors decided to keep the building in order to rent it out to tenants and to potentially benefit from increases in property prices. ABC measures investment properties at fair value. On 31st December 2011, the property has a fair value of 625,000.
Senator, can you hear me?
Yeah, I can hear you.
Okay.
Required.
Okay.
Required. Discuss the accounting treatment of the building in the financial statements of ABC for the year ended 31st December 2011.
Okay. So the issue now is you can see that they are transferring the assets from what? Owner occupied to what?
Investment property.
Okay. So what is the method that they are using for the owner occupied?
I think that's a cost model.
Okay, they are using cost model. But what is the model that they'll be using for the investment property?
They'll be using fair value.
Okay.
for
So
investment
the
property.
assets should be transferred at what? Fair value.
Fair value.
To the investment property. You see, this question is very straightforward. This one, they have given you the carrying value. Okay. So sometimes they will give you the value. You have to determine the carrying value yourself. You have to do some depreciation to determine the carrying value. You can see that these people, they are vacating the building on the same day, which is the 1st January 2011. And the amount given to us over there is the carrying value. So we don't have to do any calculation to get a carrying value because they have given us a carrying value already and they are vacating the building that day. Okay, so the question now is the carrying value of the asset is what? Is 500,000. And the fair value as at the date of what? As at the date of the change is 600,000. So the assets should be transferred to investment property as 600,000. So at the date of the transfer, we just assume that we are using fair value for the PP. So we look for a surplus, a revaluation surplus on that. That will be 600,000 minus 500,000 because in our books, the asset is 500,000, but we are transferring it at what? 600,000. So we are going to have a gain of what? 100,000. And this will be deemed as a revaluation gain. Okay. Then the asset will now be transferred as investment property. The investment property will now be 600,000 at the beginning of the year. And we are using fair value model. Okay. At the end of the year, we look for the fair value. At the end of the year, we look for the fair value. What is the fair value at the end of the year?
625.
Okay. So we are going to have a fair value gain of how much? 625,000 minus 600,000. So this will be, would that be 25,000?
Yes.
Okay. So this will go to profit or loss because it's a gain on investment property. But this will go to other comprehensive income. We assume that we revalue the assets before we transfer. So if you're using cost model and you want to transfer the assets, you want to change the use to investment property, the question is, what model are you going to be using for the investment property? If it is fair value model, you revalue the asset before you transfer. You revalue the asset before you transfer. Okay. That question was straightforward. But if you have time, look at question 6. Okay, I'm here to solve like big people their question, not small boys their question. Let's take question 9. Let's take question 9. Then we take question 10. If we have time, we take question 11. But let's take 9 and 10. Okay, the 11 you try it.
Viamosi wished to expand its overseas operation and on 1st May 2015 acquired an overseas property with a fair value of 58.5 million in exchange for the building. In exchange for the building, Viamosi paid the supplier with land, which Viamosi had held, but for which it had yet to determine its use. The carrying amount of the land was 5 million cedis, but it had an open market value of 7 million. Viamosi was unsure as to how to deal with the transaction, and so has transferred 5 million from investment properties to property, plant, and equipment. The transaction has commercial substance. In addition, Viamosi spent 0.5 million to help relocate staff to the new property and added this amount to the cost of the building. Viamosi has made no other entries in its financial statements in relation to the property. Viamosi has a policy of depreciating properties over 35 years and follows the revaluation model under IAS 16. As a result of a surge in market, it is estimated that the fair value of the property is 75 million dinars as at October 2015. Required. Advise the directors of Viamosi on how to correct the accounting treatment of the overseas property. showing the adjustments needed in the financial statement for the year ended October 2015.
Okay, looking at this question, this question can never be financial reporting question. Financial reporting question, they don't mix standards together. This is a mixture of what? 3 standards. Okay, this is how the corporate reporting question will be. They mix the standards together. They can have one question which will be involving about 4 standards. If you look at this particular question, we have investment property as a standard. We have PP, and we also have what we call IAS 28. Effect of what? Changes in foreign exchange what? Currency. All right. You can see that the company is acquiring the PPE through exchange, isn't it? The company is acquiring the new PPE through what? Exchange. They are giving land in returns for what? The property, isn't it? All right. And the property was first classified as investment property. And the question says that the transaction has a commercial what? Substance. So if there is an exchange transaction which has a commercial substance, there is a way that we account for it. If it doesn't have a commercial substance, then you can only transfer the carrying value of the asset that you are giving out. But if the asset has a commercial substance, the question now is, what is the value of the asset that you are giving out? Okay. If you are giving out an asset which has a market value of 7 million, the meaning is that you are giving this asset in return for an asset that is equivalent to this amount, isn't it? Can you give a computer that you purchased 25 million to a phone that will be bought 20 million? Your computer, 25 million, you want to give it in return for a phone that can be purchased for 20 million. Will you do that? Can we do that?
Depends.
No. All things being equal. It does not matter, it depends.
No.
It can never be done, isn't it? In the business world, it can never be done. If you are giving a machine that costs 25 million for a phone, the assumption is that the machine and the phone are having the same what? Value. Are we okay? Okay. So the question now is, the land now has a market value of what? 7 million. So whatever we are going to give the land in exchange for, that particular item should also be deemed to have what? The 7 million. So if you are doing exchange, if you can determine the fair value, ask yourself, what is the fair value of the asset that you are giving out? So you are trading the asset for the same amount, unless they will say that the new asset has this amount, then you are going to pay cash in addition. But if there is no cash payment in addition, the asset that you are giving out and the asset that you are receiving, the asset that you are receiving should be recognized at the carrying value, not carrying value, at the fair value of the asset that you are giving out, or the market value of the asset that you are giving out. The assumption is that you can't give something for an item that is lower, or that its price is lower than what you are giving. All things being equal. This is a business word. So don't say the person is your wife, the person is your, no. All right. So the property, the land, the carrying value of the land has a carrying value of what? 5 million, but has a market value of what? The fair value is 7 million.
7 million.
Okay. So the issue is, even if the property that you are having is 6 million, the value of the property is 6 million. No, we don't recognize the property as 6 million. We don't do that. We assume that the property that we are giving the land for is also 7 million. So the exchange is determined based on the fair value of the asset that you are giving out. Unless the fair value cannot be determined, then we use the carrying value of the asset that you are giving out. Okay, so in this case, the land, which is having a carrying value of 5 million, will have to be revalued. We have to value the land. We have to value the land before we give it out. So we now have 7 million minus 5 million. We are going to have a gain of what? 2 million. So we are going to have a fair value gain of what? 2 million, because we have to revalue the land before we give it out. So in our books, the land is 5 million. By the date of the exchange, the land has a fair value of what? 7 million. So we are carrying the land as an investment property. So the land has to be fair value before we give it out. So if you fair value it, it means that you have to bring the land to 7 million. If you bring it to 7 million, it means that you'll be having a gain of what? 2 million. Okay, so you are giving the land out. Look at this question. What was the value of the property in terms of what? Dinars. What was the value of the property?
58.5 million dinars.
Okay, and 9 dinars is equal to 1 cedi. So what are we going to do? If you want to change this, it means that we have to divide this
by 9.
How much are you getting?
6.5 million.
You are getting 6.5 million.
Yeah.
Okay. You cannot give a land which value is 7 million for property that is 6.5 million. No. Or in the business world, we can't do that. So we assume that we are giving the land for something that is also what? Of the same value of the land. That is an exchange, barter trade. Unless the question says that the company is going to pay additional amount of this, or the overseas customer is going to pay additional cash of what? 0.5 million. If that is not the case, the value of the property should be the same as the fair value of what we are giving in return. So the property will be classified at what? 7 million at the date of the exchange. And this happened at what date? The exchange happens at which date? I can see May 1 through X5. Okay. What is the reporting period?
October.
Okay. So that will be October to X5. From May to October, how many months is that?
6
months.
Is what?
6 months.
6 months. Okay. But the question now is, our property, is it a building or is entirely land? We don't know, isn't it? The property that we are acquiring, we don't know that it's entirely what? Land or is a property. Can we determine that? Can we determine the property that we are having is a land or is a building? Do you have any
Yes.
information to determine
It's
that?
a building.
Yes.
It's a building.
The question states that.
But the question says we are
Okay.
depreciating it over 35 years. That means it's not
Okay.
land.
In exchange for the building, okay, the question even says that in exchange for the building, okay. So it means that for this year, the year end, we are going to use the building for how many years? 6 months. Am I correct with that?
Yes.
Okay. So that will be 7 million divided by 35 years times 6/12. Are we correct? Are we correct with that? Am I correct with that?
Yes.
Okay, how much will be the depreciation?
$0.1.
0.1. Okay. So we are going to have 0.1 million. Okay. Okay, 0.1 million. What will be the carrying value?
6.9.
6.9. Okay. Let's now come here. The company carries the property at what? They are using fair value model for the property. Okay. Okay, Monday. The company carries the property at what?
Sir,
Yeah.
the depreciation I sure is 0.1. I thought it's 1 mil. Okay, that
Okay. If the fundamentals are weak, the decimal places will expose you. Let's move on. The company carries the property under what? The company carries the property under what? Which model?
Revaluation model.
Revaluation model. Okay. If you come to IAS 21, okay, effect of changes in foreign currency and those ones, we have two major items. We have monetary items and non-monetary items. Okay, if you come to monetary items, those are items that are going to be settled at a later date. So payables and those things. Whenever you buy something on credit, it means that you'll be paying the person. Whenever you buy something on credit from the person overseas, it means that you are owing the person and you'll be paying the person based on the exchange rate. So at the end of every year, you have to revalue it, or you have to fair value the amount that you'll be paying. Even if you are taking loan, you have to fair value it to know the amount that you are paying at the end of every year. If you sell to someone overseas on credit, you're going to receive the money from the person. So the amount that you are going to receive will depend on the exchange rate at the reporting date. So in actual sense, we fair value only monetary items. No monetary items. If you buy an asset from someone and pay by cash, you are not owing the person. So you just translate the asset at the date of the transaction. That is the end, because you're not going to pay anything. So we translate at the report at the acquisition date and we don't do anything. But if you are going to carry the asset at fair value, or if you are going to carry the asset at revaluation model, it means that the fair value of the asset will depend on the what? The exchange rate at the date of the revaluation. So you can see over here is that the company is carrying what? The asset at what? Revalued model. So at the end of the year, we have to find the revalued amount of the asset. We have to find the revalued amount of the asset. If the asset should be carried at a cost model, we don't do anything. We don't fair value it. We don't fair value it. So at the reporting date, the question now is what will be the revalued amount of the assets? The revalued amount of the assets. Okay, you can see that they have given you the value of the asset in what? In dinars, and that will be 75 million dinars divided by the its equivalency in Ghana city. So 75 million divided by 9.5. What are we getting? $7.89. So the surplus will now be what? The surplus will be, can we say that, can we approximate to 7.9 so that we can get 1 as a or? So the surplus will now be 7.89 minus 6.9. What are we getting? I'm getting 0.99 million. Is that correct?
yes.
Okay, so this is how we go about this question. But let's look at a major issue here. There is also a major issue here. They say that the transaction has a commercial substance. If the transaction is having a commercial substance, what you do is that the asset should be transferred at fair value, or the new asset, the asset that you are receiving should be measured at the fair value of the asset that you are giving out. Okay, when they say the asset is not having, or the transaction is not having a commercial substance, the company can go ahead to transfer the asset at carrying value. Okay, let's come here. They say that the transaction has a commercial substance. In addition, the company name, I cannot pronounce that name, spent 0.5 million to help relocate staff to the new property and added this amount to the cost of the building. Added this amount to the what? to the cost of the building. Okay. Has not made other entries in the financial statement in relation to what? To the property. So it means that in their books, what they'll be having is that they'll be having building. They'll be having building to be 5 million plus 0.5, which will be 5.5. Are we okay there? Okay. But the relocation cost, should that cost be capitalized? Should the relocation cost be capitalized? Should the relocation cost be capitalized? It should not be capitalized, isn't it? So in the statement of profit or loss, we are going to have a depreciation of 0.1 million. We are going to have the relocation cost. It should be expense. Relocation cost should be expense, 0.5. Other comprehensive income, we are going to have a revaluation surplus. Revaluation surplus of 0.99. Okay. The company is already having 5.55 in their statement of financial position in respect of what? The property. But the current value of the property is 6.9. So what we have to do? We have to go and add 1.4 to this to now have the 6.9 in the statement of financial position. But the relocation cost should be expense because it's not a cost that is directly attributable to what? To the building, or it's not a cost that we incur to bring the building to the state that it will be ready for use. The building is already in a state that we can start using it. So any other cost that we incur afterwards should be what? Should be subject to what? The subsequent expenditure on an asset. Okay, so the relocation cost is a cost that is incurred because we are taking the property, but that cost is not a cost that we have to incur to bring the building to the state that it will be ready for use. We can decide to hire a new staff there and pay them. So the relocation cost should not be a cost that should be capitalized. It should be expensed. It should be expensed. So profit or loss, I've forgotten to bring the gain on the revaluation. So we are going to have a gain on the revaluation. So the gain on the revaluation will be 2 million. Okay, I've forgotten to bring that. All right, let's look at question 10, the last one. Then we call it a day. Senior
Aqua holds properties for investment purposes. At 1st July 2015, Aqua held 10-floor office block at a fair value of 90 million, with the remaining useful life of 15 years. The first floor was occupied by Takwa staff, and the second floor was let to Dunkwa, a subsidiary of Takwa, free of charge. The other 8 floors were all let to unconnected third parties at a normal commercial rent. When Dunkwa vacates the property next year, it will be let out to third parties. It was estimated that the fair value of the office block was 96 million at 30th June 2016. TAPA has a policy of restating all land and building to fair value at each reporting date. The only accounting entries for the year ended 30th June 2016 in relation to this office block has been to correctly include the rental income in profit and loss. It can be assumed that each floor is of equal size and value. Depreciation is charged to administrative cost. During April 2016, an explosion at a different office block caused substantial damage, and it was estimated that the fair value fell from 20 million June 2015 to 14 million at 30th June 2016. TAQA has estimated that cost of 3 million will be required to repair the building, but is unsure whether to carry out the repairs or whether to sell the block for a reduced price. The property has been left in the financial statement at a value of 20 million. provision of 3 million for the repair cost was charged to other expenses. Required. Explain the suitable calculation, how the two office blocks should be accounted for in the consolidated financial statement of Takwa Group for the year ended 30th June 2016. B. Explain why the accounting treatment of the term floor office block in Takwa's individual non-consolidated financial statement would differ from the treatment in the consolidated financial statement of Takwa Group. Calculations are required.
Calculations are not.
Oh, sorry. Calculations are not required.
You like calculations so much.
It's you.
Me. Calculations are not required. Okay. You can see that this particular question is also having what? How many standards? How many standards can we see in this question?
There is IP, there is owner occupied.
Okay.
That's a PPE.
Okay. And there is what again? There is what?
IAS.
Someone say something. There is what? I can't hear you. Ben, we can't hear you.
I'm sure he's talking about consolidation.
I'm talking about a separate entity.
Okay.
So is it 28 or 27?
The separate entity, I'm sure it's 27. The 28 is joint venture.
Oh, okay.
Okay. Someone mentioned something. Someone mentioned a standard. Gina, were you the one?
No, sir.
Someone mentioned a standard. A lady mentioned a standard. The person should mention a standard again. Someone mentioned a standard.
Is it 8?
No. The person mentioned a standard. Someone mentioned a standard. Or I was mentioning a standard in my head. I heard someone mention 37. Or is not this class? Okay. We also have 37 there, provisions. You can see that the company is making a provision for what? Repair cost, isn't it? Yeah, a repair cost is a cost that can be avoided. The company can decide to sell the property or they can decide not to sell it. So the repairs cost can be avoided by selling the property. So maintenance costs, future maintenance costs or future repairs costs, we don't make provision for that because it can be avoided. How do you avoid it? You can avoid it by selling off the property. So they should not even make provision for the repair cost. Okay, that is the 37 parts. Let's come here. The people, they say that the people have 10 what? Office what? 10 floor office block at a fair value of 19 million with a remaining useful life of 15 years. The first floor was occupied by what? Takwa staff, and the second floor was led to what? To Dunkwa, a subsidiary of Takwa, free of what? Charge. So the first two floors are what? Owner what? Occupied.
Occupied.
Okay, Tessa, are you getting the argument where staff?
Yeah.
Staff are occupying. So the two of them are what? Owner occupied. So Takwa will be giving out only what? 8 of the floor. Okay. The question moves ahead. Now the question goes on to say that the properties are of the same size and the same value. The question, yeah.
Before you go, the free of charge.
Yeah.
If it were not there, what will change?
Nothing will change.
Nothing
The
will change.
only thing that will happen is that you reverse the renters because you can't be getting money for yourself. So
okay.
the renter
that's in the group group account.
In the group account, you are going to reverse it.
But in the individual account, it will be there.
It will be there because they are reporting it for themselves.
All right.
All right. So what they are saying is that they are saying that the floors are of the same size and the same value. What they are saying is that you can pro rata the 90 million. That's what they are saying. So the 90 million can be prorated. That's what they are saying. So what you do is that currently we are having 90 million, which is the fair value of the building, 90 million, but we have 10 floors. So one floor will be how much? That's what they are saying. So you can do the 90 divided by 10. So one floor is what? 9 million. Am I correct with that? So let's find
Yes.
the owner occupied, those that will be classified under PP, which is the 2 floors. What will be the value? The value will be 2 over the total floors times the total amount. So I'm going to be getting 18 million. Is that correct? So those that will be classified as investment property, those that will be classified as investment property will be 8 over 10 times 90. Because these things, they are of the same size and the same value. So you just prorate the amount. So 8 over 10 times 90. I'm getting 72 million. Okay. So 72 million will be for investment property, and the 18 million will be for what? Owner occupied. Benjamin, your this thing is giving a bad signal. I don't know whether you are using earpiece or something like that. Okay.
Yes, please. So
Yeah, the earpiece is the one that you are using is a fake one. My own is the original one. So I'm also using earpiece, but
okay.
it's not giving a bad. So you have to see me after class, then I'll give you the original one. Okay.
Yeah.
That is just by the way. So don't be
Free of charge.
offended. Media, if you don't know me, you will be offended. Every day you'll be annoyed and you will die out of heart attack. So media.
I that.
Okay. So don't worry. Do you have a sister who is a DB? Pay attention to the word, a DB, not just a sister. Okay. So if you have, we'll talk about that later.
Yes, sir.
Okay. For now, let me focus on this question. Okay. So the other 8 floors were all let to unconnected or third parties at a normal commercial rent. At a normal commercial rent. So investment property is where you are giving the listing to someone who is not related to you, an independent third party. Okay. When Dunkwa vacate the property next year, it will be let out to third parties. They are here to vacate it, so still owner occupied. It was estimated that the fair value of the office block was 96 million at 30th June 2016. TAQUA has a policy of restating all land and building to fair value at each reporting date. You know what they are telling you there? They are telling you that they use revaluation model for PPE and fair value model for what? Investment property. Are we okay? All right. When are they doing this? When do we have the 96 million? That is the reporting date. That is the reporting date. So we decide to what? Give the asset out at which date? At July 2x5. So from July 1st to June 30th June 2x1. That is 1 year. Are we correct with that? So July 2x5 to June 2x6, we are going to depreciate the PPE. So the PPE will be depreciated. Please, can you hear me?
Yes, sir.
Okay. So the PPE will be depreciated at 18 million divided by the remaining useful life, which is 10 years. What will be the yearly depreciation? What will be the yearly depreciation?
1.8.
1.8 million. Okay. What will be the carrying value of the PPE at the reporting date? Carrying value of the PPE.
The remaining useful life is 15 years.
Is 15.
Yes.
Sorry. Okay, sorry. I saw the 10 there. Okay. So it's 15 years. So what will be the yearly depreciation?
1.2.
1.2.
1.2. Okay, so the carrying value will be what?
16.8.
16. So it will be 18 million minus 1.2. That will be 16.8. The carrying value of the investment property will still be the 72 million because we are using fair value model. So we don't depreciate investment property under fair value model. Okay. But the question now is, at the reporting date, the revalued amount is what? Is 96 million.
96.
This 96 million will now be shared again. 2 for owner occupied, 8 for what? The investment property. So let's share this. The revalued amount, PP will be taking 2 out of 10 because this is for the 10 floors times 96. What are we getting? And the investment property, 26.8. Investment property will be 8 over 10 times 96. What are we getting?
Yeah. The first one is 19.2.
19.2.
The first one.
Okay, 19.2. Okay. The second one will be what? What will be the second one?
76.8.
76.8. Okay. So the question now is, let's compare this with the carrying values now. So let's find the revaluation surplus. It will be 19.2. Okay. 19.2 minus the carrying value of the PP, which is 16.8. 16.8. Let's come to the gain on the investment property. Gain on the investment property will be the fair value, which is 76.8 minus 72, because we are carrying this at fair value. So the first one will give us what? 19.2 minus 16.8, 2.4 million. Okay. Gain on the investment property will be what? 76.8 minus 72. 4.8. Okay. All right, let's go back to the question. Explain with suitable calculations how the two offices blocks should be accounted for in the consolidated. Okay. So this one they are talking about only the 2 floor. Oh, and I did all these plenty calculations. Okay, it is good that we solve it at like the way it should be solved. So explain with suitable calculations. So what will happen is that the 2 floors will be carried as owner occupied or will be measured as what? PP, which will be depreciated at 15 years. So the annual depreciation will be 18 divided by the 15 years. The 18 is what? Is a portion of the carrying value of the 10 floors, which will be 2 over 10 multiplied by that. So the cost of the cost of the 2 floors at the date of the renters is 18 million. This will now be carried as what? Owner occupied, because it's the staff and the subsidiary that are occupying that particular floor. So that will be accounted for as owner occupied and be depreciated over the remaining useful life of the building. So that will be 18 divided by 50. Every year, the company has to charge what? 1.5 million. Or for the year end, for the year end, 30th June 2 exits, the company has to charge a depreciation of 1.2 million in respect of the 2 floors. By the end of the year, the company uses revaluation model. So they have to revalue the 2 floors to their fair value. In that case, the company should report revaluation surplus of 2.4 in the other comprehensive income. And the 2 floors will now be measured at what? 19.2 in the statement of financial position. So the 2 floors should be accounted for as a PP. That is the first thing. If they are accounted for as a PP, then it means that they have to be depreciated and revalue at the end of the year. Okay, that is how they should account for that. But let's assume that the question is not asking to account for only the 2. They say you should account for only the 2. That's how you are going to account for it. Let's now solve the question as if nothing is happening. Let's solve the question as if nothing is happening. Let's count to this one. It was estimated at a fair value. Okay, an explosion at a different office block caused substantial damage, and it was estimated that the fair value fell from 20 million at 30th June to 14 million at 30th June 2006. TACWA has estimated that cost of 3 million will be required to repair the block, but it is unsure whether to carry out the repairs or whether to sell the block for a reduced price. The property has been left in the financial statement at a value of 20 million. A provision of 3 million for the repair cost was charged to other expenses. So, at what value? The second building, what should have been the value of the building in the statement of financial position? What should have been the actual value? What should have been the actual value?
14
million. So what we do is that there will be a loss, a fair value loss on that. So we have 20 minus 14. There will be a fair value loss of 6 million. So the property should be reduced to 40 million, where the company will charge a loss, a fair value loss of 6 million to statement of profit or loss. But the question is, do we have to make provision for this particular repair cost? Do we have to make a provision for that? No, provision is supposed not to be made. So after the company make the provision, what they do is that they debit profit or loss with a 3 million and they credit what? Provision, a non-current liability with a 3 million. But we don't have to make provision because we can avoid the repair cost by selling the building. So we don't have to make a provision because there's no obligation to incur that particular cost. We can decide to sell it and there will not be any future obligation. So since this is what we did by recognizing the provision, we have to go and reverse it. Reversing it means that we debit the provision in the statement of financial position of 3 million. Then we now credit our profit or loss because that was used to reduce our profits. So the 3 million that was subtracted from profit should go and be added. And the provision in the statement of financial position should be removed. B, explain why the accounting treatment of the 10th floor office block in TACWA's individual financial statement will differ from the treatment in the financial statement of TACWA. Calculations are not required. Okay, in the individual statements, since the building are being given out, in the individual statements of financial position, TACWA will be thinking that they are renting the building to what? To the staff and also the subsidiary. So they are going to recognize the building as an investment property. But if you come to the consolidated financial statement, the staff and then the subsidiary will be seen as part of the company. So it will be owner occupied. So the classification in the individual group will be an investment property because TACWA is thinking that they are giving the building out for rent. And the subsidiary and the staff will not be part of the company in that case. Okay, but if you come to a group, the subsidiary will be seen as part of the group. Therefore, the 2 floors will be treated as what? Owner occupied. So in the individual statement of financial position, it will be an investment property. But if you count to
for all 10 floors,
if you count to the group perspective, it will be classified as a PP. It should be classified as a PP because it is owner occupied. That's what they are talking about there. The question 11. Okay, Teta.
I think the B is talking about all the 10 floors, not just the 2.
Oh, the 8 of them will be classified as investment property, and the 2 will be classified in the individual statement. They are going to classify all the 10 floors as investment property. That's what I said. They are going to classify all the 10 floors as investment property, including the 2 occupied by the staff and the subsidiary. So
Why?
all of them will be classified as investment property.
But they are occupying the first one. Their staff are occupying the first one.
Sorry. One will be classified as owner occupied, and 9 will be classified as what? Investment property.
Okay.
All right. Thank you. Okay, Charlie, the question 11, try it. Okay, so these 2 questions are the question that are for the seniors. The question 1 up to 8, there are questions that are for financial reporting people. Okay. So that is all. So if you don't have any question, corporate reporting people, we will meet at 6 p.m. So I'm far from home. I have to go and pick her and go to the house. So you people should be waiting for the video maybe after 5 p.m. I will upload it for you people. All right. If you don't have any question, thank you all for coming. We'll be treating the standards small on Saturday so that we'll be treating some of them on Monday too, so that we can move fast. Okay, we can move fast. So on Monday, we are treating impairment of non-current assets. Okay, on Saturday, we look at borrowing costs. Then Monday that will come, we look at non-current asset held for sale and discontinued operation. Maybe Saturday, we look at financial instruments. So we'll be looking at it like that so that we can move fast. All right. If we don't have any question for me, and I also don't have any question for you, corporate reporting people will meet in the evening. Thank you all for coming. Okay.